I spent the last 25 years immersing myself in the fields of accounting, finance, and money management by earning both a bachelor's and a master's in taxation, as well as accounting. I worked 10 years in public accounting, and while working, I passed the CPA exam. And over the last 9 years, I've been able to advise some of the world's most successful public figures and entrepreneurs. Over the course of my 19-year career, I've learned a lot of lessons, as well as identified some of the money habits that these successful public figures and entrepreneurs made each and every day that got them to where they are today. In this video podcast, I'm going to be going over the 5 most common bad money habits that are keeping many people from achieving financial success. So let's get right into bad money habit number 1, and that is being house poor. What does that mean? Being house poor means spending so much on your mortgage or your rent that you don't have enough left over for savings, retirement, or anything else. By tying up so much of your take-home pay or your income to your housing expense, you don't have anything really left over, and that leaves you financially vulnerable for unexpected expenses or even job loss. What does this look like in a real life situation? Let's say your take-home pay is $5,000 a month, and your rent or your mortgage adds up to $3,000. That is too much because there's not much left over after you pay your housing expense. Well, how do we break this habit? I like to call it the 28% rule of thumb, which means that all your housing costs, that might be your mortgage or your rent, should not exceed between 25 and 30%. So we don't want to exceed between 25 and 30% of your gross income. So for example, let's say your gross income for the year is $100,000. Our housing expense should not exceed between $25,000 and $30,000 cumulative over the course of the year. Figure out what is your gross income for the year, and then what is that 25% to 30%? If you're above 30%, consider refinancing, downsizing, or renting until you're financially able to, or even look into how do we increase our income, right? Or have other earning opportunities so that we can be within that 28% range, right? 25 to 30%. The second bad money habit that I've noticed is not having an emergency fund. What does this mean? Having no savings set aside for sudden expenses like medical, car repairs, or a job loss, right? An emergency fund really will help you to alleviate a lot of the stress related to any sudden or urgent expenses that might arise in your life. And what happens is that when you don't have an emergency fund, you're relying on credit cards as well as personal loans. And that also we know has high interest rates. The average interest rate right now is between 22 and 25% that credit cards as well as personal loans charge. And that's going to create financial stress and a debt spiral, right? That sometimes it's really hard to get out of. So how do we break this habit? Start with an emergency fund goal of $1,000, right? And then one day you want to build ideally between 3 to 6 months worth of an emergency fund. And that 3 to 6 months is all of your monthly expenditures, including housing. We want to have between 3 and 6 months in emergency funds so that even if not a single dollar comes in for 3 to 6 months, you're able to pay for your house, your apartment, your car, and able to feed your family. One way to do this, and I'm going to repeat this, is to automate a certain percentage of your take-home pay each and every time to a high-yield savings account. Okay, so we want to automate this process. The third bad money habit that I've noticed was paying yourself last. What does this mean? Most people like to pay off credit card bills, mortgage, other things, lifestyle expenses before they pay themselves. And what I mean by paying yourself is savings, going towards that emergency fund, investments, and retirement. You want to pay yourself first, not last. So why is this a problem? If you end up paying bills, mortgage, housing first, you have nothing left over for savings. You have nothing left over for retirement. So you want to think about your future self for retirement, start planning for retirement, emergencies, and different financial goals that you want to make sure that you're taking care of yourself as well as your loved ones. How do we break this habit? Pay yourself first. And what does that mean? We want to automate a certain percentage, and I say a minimum of 10% of each take-home pay into a high yield savings account, right? So you don't even have to think about it. If you know that you receive payment on the 1st or the 15th of every month, maybe the 2nd or the 16th or a day or two afterwards, you just have an automated percentage or set amount going to a high yield savings account at your bank. Automate that process and pay yourself first. The fourth bad money habit that I've noticed was using credit cards for everyday expenses. It's using credit cards not just for the rewards, but because you don't have enough cash to cover essentials like groceries or gas. Many of us, and I'm definitely very guilty of this, like to spend my credit card and not carry cash or use my debit card for the rewards or the points. However, the credit card companies know that a lot of people are paying for expenses that they might not be able to cover in cash to fully pay off the statement at the end of the month. So what you want to make sure is that you're not paying everyday expenses with credit cards unless you know that you have enough cash to pay off the statement at the end of the month. So why is this a problem? A lot of people in the US are in credit card debt, right? That we know that it's piling up and the interest and the only people that are really benefiting are the credit card companies. So you want to make sure you're tracking your expenses to find any leaks, plug those holes, and prioritize cutting costs or increasing your income, right? Going back to what I talked about, really looking at where can I cut expenses and where can I increase my income? And then also only use credit cards when you know you can pay that expense in cash so that at the end of the month, you know you can pay off the balance fully. Okay. Number 4 is highly critical to earning wealth. And the 5th is to not track your income and expenses. What does this mean? You don't know how much you're earning as well as what you're spending, right? And you know that saying, you can improve what you don't measure, right? Once again, you can't improve what you don't measure. So it makes it nearly impossible to save, invest, or to hit your financial goals, right? If you don't know what's coming in, nor what's going out. How do we break this habit? You want to use an app like Mint or a spreadsheet, right? There's a lot of really good apps out there to track your personal finances. You want to make sure you're using a personal finance app to track those expenses. And you want to review your cash flow or these statements and these apps at least on a monthly basis to make sure you're tracking, because all of us have leaks, right? When it comes to expenses, whether it's a subscription to a streaming service that we're not really utilizing. So you want to make sure you're reviewing your monthly expenses to track any leaks, as well as look for opportunities, right? Because one less dollar spent is one more dollar saved. If you're guilty of one of these habits, and I personally have been guilty of these habits, don't feel bad. We've all been there. And the key is awareness and action. Thank you for watching. And I hope you were able to resonate with at least one idea or suggestion and be able to take action so you can achieve your financial dreams. Until next time, bye.